Today I'm going to do a quick analysis of Bed Bath & Beyond, BBBY. So I'm going to use the BTMA stock analyzer. It's here at btmastockanalyzer.com. Click on Analyze Stocks. And I have it here already set up. But if not, I could just type it in here or type in the company name here. Click Analyze Stocks. Okay, it says the market price is $7.68. The analyzer doesn't recommend to buy this stock. It says reason negative figures found in company rating categories ROE and ROIC. So if we look at summary info, it has a rating of 30 out of 100. So obviously this looks like it's not a good company or no longer a good company if it once was. If we look at the company rating here, so upward price per share over the last 10 years is only 2.5 out of 17 points. Return on equity is 0 out of 16. Earnings really looking bad too, 1.3 out of 16. Has an ability to recover after a market downturn or crash. ROIC is also 0 out of 12. It has good gross margin percent score, 12 out of 12, and it's not a growth stock according to the PEG ratio score. Okay, so let's click on the stock ticker to get more information. So the price upward trend has been going the opposite of upward. So you could see from 2015 it's been going down consistently, kind of stabilized within the past year. EPS, so the earnings have really took a dive to negative earnings now. Okay, that's market recovery, which we talked about before, 15 out of 15. Okay, ROE is also, it took a dive here. It used to be good with ROE. We look for a score of 16 and higher for ROE. So back here in 2015, 16, 17 even up to almost 2018, the scores were okay for ROE, and the scores were very good back here. But the company has really taken a dive after, say, 2017. ROIC, same kind of thing. We look for 16 or higher, and it was good all the way up to 2017. Then things really got bad after 2017. Gross margins, we look for 30% and over. So the company still has good gross margin, but the problem is that it's been declining over the years. So that's also a warning sign about this stock. PEG ratio, it's showing that it's not a growth stock. You want to have between 0 and 1 for this PEG ratio, and so we're not within those limits. At 2019, the last information here has us at 2.5, so not a growth stock right now. Okay, so overall the fundamentals show that the company is not doing well. Its scores are not good. 30 out of 100 is a terrible score, and also the fundamentals are declining too, so it's getting even worse. So these are all bad signs for the company. So I wouldn't consider it to be a good company anymore. Okay, let's go back and look at the stock value. So we said that the stock price was around $7, and we have here intrinsic value is around $8.30. Estimated stock value is around $13. If we click here intrinsic value, we'll see different valuation. methods here. We have price earnings model. So this one doesn't even show anything, probably because the earnings have been negative. Okay, so this one isn't going to really be valid right now. Okay, residual income is $1.14. Residual income considers more like the assets of the company. So this would tell us that, you know, it has some assets, but not too much. Discounted cash flow is around 15. Let's look at that. Okay, so you could see the growth rate estimated for the next 5 years around -9%, and then the years 6 through 10 is -4%. So we're seeing negative growth here. $15 intrinsic value. Market price is at $7.68, but you have to consider different methods of valuation. Don't just consider one. You have to look at various methods to get a more ballpark figure or a range of where the value is, because each of these depends on different metrics. Okay, so here we have an average intrinsic value of around $8.30, which is near the market price, $7.68. But as we said, looks like the growth rate in the future could be negative. So this, as you keep holding this stock, this would tell me that the stock value could be going down further in the future. And according to the fundamentals, the stock might be likely that it's going to keep going down in its share price as well. If you remember going back when we looked at the share price here over the past 10 years, see, it's been trending downward. Okay, I'm going to go back and click on pricing. So 52-week high was around 19, 52-week low is around 7, 15, so we're close to the 52-week low. So again, that kind of proves the point that this stock is moving downward towards its low and could keep going lower. Okay, miscellaneous fundamentals. This looks more at the balance sheet and tells us about the financial strength of the company. So the debt to equity, we want to look for less than 1, and this has greater than 1, meaning that it has more debt, so it owes more than it owns. So this is a warning sign here too, not financially healthy in the long run. Current ratio is okay right now, but you know, it's at 1.4. We look for greater than 1. So in the short term, the company seems okay. They have enough cash to pay off short-term liabilities, but in the long term, not very good here. PG or PE ratio doesn't even register because of the negative earnings. Dividend it's paying now is 7.67. Some people might look at this and be like, oh, that's great, it pays 7% dividend. However, if you're buying a stock of a bad company that's getting worse and having negative growth, and it has more debt than equity, then that's not really a good situation, because eventually this dividend is going to dry up and the share price is going to keep going down as you hold it. So you end up losing in the long run. Okay, so that sums up the analysis of Bed Bath & Beyond. I wouldn't invest in this company now, and if I'm holding this company, then I'd be thinking about getting rid of it, definitely. And I hope you enjoy this analysis. If you want to try out the BTMA stock analyzer, I'll put a link in the video description for a free trial. Have a nice day.